Let me describe two people to you. Person A wakes up on a Sunday morning, opens an app on their phone, deposits $200, and spends the next 4 hours making a series of bets based on statistics, gut feelings, and the completely irrational belief that because their team lost the last 6 games, they're statistically due for a win. By 4 p.m., they're down $180 and telling themselves they'll make it back next week. Person B wakes up on a Sunday morning, opens an app on their phone, deposits $200, and spends the next 4 hours buying and selling short-dated options contracts on a stock they saw mentioned in a Reddit thread, based on vibes, momentum, and the completely irrational belief that because the stock dropped 3 days in a row, it's due for a bounce. By 4 p.m., they're down $180 and telling themselves they'll make it back next week. Here's the question. Which one has a gambling problem? If you said, Person A, congratulations, you've absorbed exactly what the marketing departments of every major financial platform, sports betting app, and crypto exchange wanted you to think, because the answer is both. The answer has always been both. The only difference is the costume. And today we're going to talk about how gambling didn't suddenly become mainstream. It just figured out that if you change the language, the interface, and the target demographic, you can sell the exact same product to an entirely new audience without anyone calling it what it actually is. Let's start with sports betting because it's the most obvious and the most aggressive reinvention. For most of American history, sports betting was illegal in almost every state. If you wanted to bet on a game, you called a guy. You met someone. It existed in the shadows where society had decided it belonged. And then in 2018, the Supreme Court struck down the federal ban on sports betting, and what followed was one of the fastest and most coordinated industry expansions in modern American history. Within 5 years, sports betting was legal in over 35 states. Sportsbook companies spent billions, and that number is not an exaggeration, on marketing. DraftKings, FanDuel, BetMGM, and their competitors collectively spent more on advertising than most pharmaceutical companies. They put their logos on stadiums. They bought naming rights to arenas. They ran Super Bowl ads. They signed deals with every major sports league so that the leagues themselves became promotional vehicles for the betting apps attached to them. They sponsored podcasts, hired athletes as brand ambassadors, and flooded every sports broadcast with real-time betting odds until the line between watching a game and betting on a game became almost impossible to identify. And then they handed out free money, sign-up bonuses, first bet insurance, deposit matches, refer-a-friend credits. The industry called it customer acquisition cost. What it actually was the oldest trick in the casino playbook. Get someone in the door, let them win the first time, and then let math do the rest. Because here's the thing about sports betting that the apps don't put in their Super Bowl commercials. The house wins. It always wins. Not sometimes. Not usually. Always. On a long enough timeline, sports betting has a negative expected value for the bettor. It has to. That's not a flaw in the system. That is the system, and yet Americans now bet hundreds of billions of dollars on sports annually, and the fastest-growing demographic of new bettors isn't middle-aged men at sports bars. It's 18 to 24-year-olds on their phones. But sports betting is almost quaint compared to what happened with financial markets. Because if sports betting is gambling with a scoreboard, then options trading is gambling with a spreadsheet. And a spreadsheet makes everything feel serious. Here's how options work. You pay a premium to buy the right to purchase or sell a stock at a specific price before a specific date. If the stock moves the way you bet, you make money. If it doesn't, you lose the premium you paid. The further out of the money the option is, the cheaper the premium and the smaller the chance it ever pays off. It's structurally identical to placing a bet on a sporting event. You pick a direction, you pick a time frame, you put money down, and the market is the referee. The only difference is that instead of betting on whether the Chiefs cover the spread, you're betting on whether Nvidia hits $150 by Friday. But the math underneath is the same, and in most cases, the house still wins. The data here is not ambiguous. Studies consistently show that roughly 70 to 80% of retail options traders lose money. For day traders broadly, the number is even worse. A landmark study of the Taiwanese market, one of the most heavily studied in academic literature, found that over a 15-year period, less than 1% of day traders were consistently profitable year over year. Less than 1%. And yet since 2020, options trading volume has exploded. Platforms like Robinhood, which famously gamified the entire experience with confetti animations and a frictionless interface designed to make placing a trade feel like popping a balloon at a carnival, saw options trading volume increase by hundreds of percent almost overnight. The pandemic locked people inside, gave them stimulus checks, removed the friction from market access, and introduced millions of new participants who had no idea that what they were doing was functionally gambling with better branding. And then there's crypto, which is gambling that figured out how to get people to argue about its ideology. Because Bitcoin and its 10,000 derivatives aren't just speculative assets, they're speculative assets wrapped in a philosophy: decentralization, anti-establishment, financial sovereignty, the future of money, the revolution. These aren't investment theses, they're recruitment narratives, and they work because they make the gambler feel like a visionary instead of a gambler. But strip away the white paper and the Discord servers and the community and the ideology, and what you have left is an asset class with no underlying cash flows, no intrinsic value, and price movements driven almost entirely by sentiment, momentum, and the greater fool theory. The greater fool theory, in case you're unfamiliar, is the investing principle that says you can pay any price for an asset as long as you can find a greater fool willing to pay more for it later. It's the foundation of every Ponzi scheme ever constructed, and it's the business model of roughly 99% of the cryptocurrency market. And yet memecoins, altcoins, and NFTs consumed billions of dollars of real human savings before most of the projects went to zero and the communities dissolved into silence. And here's the thread connecting all three. Sports betting, retail options trading, and crypto aren't separate trends. They're the same trend. They're gambling that learned to speak fluent finance. Each one uses the language of skill and strategy to obscure the reality of odds and variance. Each one has an ecosystem of content creators, analysts, influencers, and talking heads who make their living by performing expertise and selling the dream that if you just learn enough, study enough, follow the right person, use the right system, you can beat the house. And each one profits most when the people who believe that story keep coming back and keep depositing. Because here's what they all have in common with every casino ever built. The business model is not built on occasional participation, it's built on compulsive participation. Casinos are not designed for people who go once a year and walk out even. They're designed for people who come back. Sports betting apps are not profitable because someone placed a fun $20 bet on the Super Bowl. They're profitable because of the person placing 15 bets a day, 7 days a week, chasing losses and calling it strategy. Robinhood doesn't make money when someone buys an index fund and holds it. It makes money from order flow, which is generated by trading activity, which is maximized by users who check the app compulsively and trade frequently. And crypto exchanges make their money on transaction fees, which means every buy, every sell, every panicked exit, and every excited entry puts money in their pocket whether the trade wins or loses. The product is not the return, the product is the behavior, and the behavior they're selling is the same one slot machine sell, the same one scratch ticket sell, and the same one the guy running a card table in a back room was selling 50 years ago. The thrill of the possibility, the near miss that feels like it almost worked, the win that proves the system is real, and the loss that just means you haven't figured it out yet. And the reason this matters, the reason this isn't just a philosophical observation about modern finance, is that the demographics being targeted are young, the sums being lost are real, and the long-term consequences are serious. A 23-year-old who spends 2 years chasing losses on sports betting apps, blowing up options accounts, and watching their crypto portfolio go to zero isn't just out the money they lost. They're out the compounded returns that money would have generated if they'd done literally nothing with it. They're behind. And the platforms that took that money are reporting record revenues. So the next time someone tells you they're not a gambler, they're a trader, a sports analyst, a crypto investor, a technical chartist with a system, remember this. The house doesn't care what you call yourself. It cares that you keep playing, and it built an app for that.